Welcome to the program. My name is Marty Schenkman. We have a hot and current topic. We're going to talk primarily about, but not only about, the recent tax act that Bernie Sanders proposed, which has massive and dramatic change to the estate tax system. And we're going to not only explain the changes, but give a lot of practical advice, both about what you want to do now with clients in case that act is actually passed. And in case it's passed, we're also going to talk about some of the ways that you may plan differently in the future. It will transform everything we all do. As we get started, a couple of points. The PowerPoint is on the web console. If you haven't downloaded it, you can open up the handout tab. Just click on the little caret that says handout, and you can download the PDF of that. If for any reason you missed the program, it's being recorded and will be posted to schenkmanlaw.com within a few days of the program. Peak Trust and Interactive Legal, our sponsors, will also post it. There's a library of probably 60 webinars on Schenkman Law you can access for free at any time. Many of those feature the same illustrious characters of Jonathan Blattmacher, Joy, or Bob Keebler. And there's about 150 video clips, short 10-minute video planning clips on Law Easy you may want to access as well. And we update all those all the time. We don't formally give CLE or CPE credits, but we will issue a certificate of attendance, and you'll get that automatically. Before we get started, let our two sponsors say a quick word. Vanessa?
Thanks, Marty. Welcome, everyone, and thanks so much to our panelists today for this webinar. We are once again on the precipice of potentially tremendous change in the estate planning world. And I know this is of great interest to all of us, not only as estate planning attorneys, but particularly as at Interactive Legal, because of course we want to keep all of our subscribers up to date with current law and current trends. So I'm really grateful for this program and very interested to hear it. If you'd like more information on Interactive Legal, our contact information is there on the screen, and of course please visit us at interactivelegal.com. Thanks very much.
Some of the prior programs that are on the websites that I mentioned earlier, we illustrated how to use document generation software to draft the kinds of trusts and a lot of the techniques that you probably want to use in light of these proposals before they're enacted. So Interactive will appear in those as well. Our other sponsor is Peak Trust Company. Nicole, can you say a word about Peak?
Yeah, absolutely. Thank you, Marty, and thank you to all the panelists today. My name is Nicole King. I work at Peak Trust Company. I'm a trust officer here. We're very excited to be able to sponsor today's very hot topic presentation. Just to tell you a little bit about Peak Trust, we serve individuals and families and their advisors by offering a tax-favored trust situs in either Alaska or Nevada. We are a full-service trust company, and we offer flexible and customized administrative service for all types of trusts. If you should have any questions, then please don't hesitate to contact me or any member of the Peak Trust Company team. You can find our information on the website or on the presentation materials. So thank you, Marty.
We used Peak extensively in Nevada and Alaska last year, and we'll certainly be doing so as we continue to do more trust this year as clients struggle to get planning done before the potential effective date of these acts. And I must say that Peak seemed to be working 9 days a week because they were incredibly responsive. My custom on all webinars is to try to feature a different charity on each webinar. On this webinar, it's my pleasure and honor to feature a charity that has been very close to my heart and something I've been involved with for now 15 years, which is the National Multiple Sclerosis Society. And I'm going to let Liz Adams say a word or two before we get officially started.
Wonderful. Well, thank you for the invitation to be here today. I'm proud to represent the National MS Society, and as an organization, we exist because there are people living with MS. We are determined to be a lifelong partner and resource for every person affected by MS, those diagnosed with the disease, and their loved ones. In the past 75 years, since we started as an organization, we've seen our fair share of challenges, and certainly many during the pandemic, but we're not going to stop until we have a cure for every person living with this disease. Together, we've achieved more breakthroughs for MS than the world has seen for any other neurological disease. We've paved the way for nearly all treatment option availables today. And with your support, this chapter could be the last chapter for MS. So I invite you to learn more about us on our website and reach out. We'd love to hear from you. And thanks for the invitation again to be here today.
No, my pleasure. A testament to what the society has done. When my wife was diagnosed with multiple sclerosis, now almost 15 years ago, there was a handful of drugs, and we were thrilled and thankful that there was a handful of drugs, because 10 years earlier, when we had family and friends that had been diagnosed, there was literally nothing to do. So the fact that there were, I think at the time, maybe 3 drug therapies that could be used was wonderful. And do you know, Liz, how many there are now? I mean, it's well over a dozen, maybe even.
Yeah, there's 24.
Wow. So that's a testament to the research that they have funded. So thank you, Liz, Vanessa, and Nicole, and we're going to now get started. And I'm going to have Bob Keebler. If you don't know Bob, Bob is not only a brilliant and well-known accountant, but a gentleman to boot. And Nicole, you're going to drop off too. Okay. And Joy Motak works with Sachs LLP in Clifton, or did you move?
Yeah, we're in Parsippany now.
Parsippany. I have to change it for the last umpteen years. It's been Clifton, so I got to say Parsippany. And everybody, I hope, knows Jonathan Blotmacher. You have to know Jonathan. So I don't think anyone needs more introduction. So Bob's going to kind of lead the charge, and Joy, Jonathan, and I are going to be the peanut gallery, and we're going to heckle Bob with comments, and hopefully from our discussions, a lot of interesting comments will be coming out that hopefully will give you some insights into what to do with the new law. And keep in mind, this is all new. We're all still digesting it. So it's possible that we may have some different views or unthought of views or some things that are half-baked, but we'll give you whatever we have. So hopefully you'll have some ideas. But I think the bottom line for the whole program, we all need to tell clients and educate clients, if you haven't done all the planning you can do, you better do it fast. It may not work. It may not give you the result you want, depending on what happens. But if you don't get a lot of your planning done or all your planning done before the effective dates of some of these changes, it's going to be bad news from a tax perspective. I think that's probably a fair bottom line to the whole program, but we're going to give you a lot more depth. Bob?
Well, thank you, Marty. It's an honor to be here with you, Joy, and Jonathan. What we're going to do today is primarily go through 2 bills. The Sanders bill on the estate gift and GST side, and we'll touch base a little bit on the Van Hollen bill on the whole step up in basis, actually going to gain recognition at death, very similar to the Canadian system of the deemed disposition tax. Current situation, I think we know it. We have this $11,800,000, $700,000 exemption. We're looking at, in 2026, that would fall back to $5 million inflation adjusted. And given the success of the Democrats in the last election, we do expect this to decrease, okay? But now we're starting to see the bills, so it's becoming very real. And we're in this a truly use it or lose it scenario. If a person doesn't use their exemption, it will be gone forever. That's just the heart of it. So we have to think about that. Now, if you're representing a surviving spouse, the game is much more difficult, because before she can use or he can use his exemption, you have to burn through the potential to sue from the previously deceased spouse. So that makes it all the more interesting. And we'll work through this today. Now, the rates in this bill we're going to look at go to from 40 to 45, 50, 55, and then there's a special billionaire rate. Focusing on the rates most of us would deal with, 45, 50, and 55. The whole thing comes down to, if you had somebody that just died, so I have half a dozen cases of people that have died in the last short period of time, and the issue becomes, these are very large estates, do we pay estate tax at the first death at only 40%? And some of this, you're going to have to turn back the clock to what people did in 1990 or 95, or because back then we were very good at paying estate tax at the first death. We learned to use something called 2013 over a naked life estate. Jeff Pinnell writes about that in his B&A portfolio at some depth. But there's a lot of things we have to consider. If somebody just died, do not naturally assume you're going to defer all the tax right now. That may not make sense. By the time this program's over, I think we'll understand that. Look at the next page, please.
Bob, before you go on, let me roll back a second. Jonathan, I know we've covered it in other programs, but maybe it's worth just a minute or two of time. When might these laws get enacted? There's discussion that they may not be able to get enacted until October. Might they append them to another bill? Maybe just give some insight to the audience on why these things could happen very quickly or why they may wait till October.
Well, the Congress can always pass any legislation it wants at any time, except the Senate has a special rule which allows a senator to filibuster a bill and prevent it from being voted upon as a practical matter unless 60 senators cut off the filibuster. However, there are exceptions to the filibuster rule. One is for judicial appointments, and another one is for a budget reconciliation act. As a general matter, there can only be one budget reconciliation act per every fiscal year, and fiscal years for the federal government begin October 1. We've already had one budget reconciliation act, and that was the COVID-19 legislation, which passed just a couple of weeks ago. So they'll have to wait until October to pass another one, which would be for the next fiscal year, unless they pass a bill with 60 votes. They could do that at any time.
Was that Senator Sanders calling to ask
Yes,
recommendations?
Senator Sanders was calling to find out why we weren't using his name more prevalently.
Well, but Jonathan, I had thought that in the last fiscal year, there was no reconciliation bill passed. So the American Rescue Plan was actually an extra, a bonus, if you will, so that the Democrats actually get 2 reconciliation bills that they can pass as long as they do it before the next fiscal year. So I think that's actually what the Democrats are trying to accomplish, is to get this next bill passed by September 30.
Right, and of course, they may try to do this in connection with some sort of, reconstruction bill, something for the infrastructure. And that also could be done under a budget reconciliation bill. And President Biden seems, hell-bent on doing something very significant very soon. So we'll have to see if it happens. But in any event, something could happen soon. But as we're going to discuss, almost all of the tax provisions would be effective on not earlier than January 1, 2022.
Now, one of the things that we had spoken about was for the infrastructure legislation that's being proposed, might it not be possible for the Democrats to try to cut deals with enough Republicans that this could get passed much more quickly?
Well, that's possible, Marty, and you can imagine that every senator and every congressperson is going to want some sort of infrastructure expense for his or her district, whether it's bridges, whether it's roadways, whether it's a port, New York City would be in love with getting money to rebuild the subway. And there are other areas like desperately need some sort of infrastructure for their traffic situation. They're also talking about making so many more cars electric that they want to have all sorts of electric charging stations on major highways. And almost every state would benefit. Keep in mind that the so-called blue states like New York and New Jersey and California actually pay more over to the federal government than they get back from the federal government. If you're from, a smaller state, you actually make money from the federal government. Even though people complain about taxes and it's all unfair, many, many small states, and they can be red states, get back more from the federal government than their citizens pay over to the federal government. So maybe they'll go to someone in the state like Maine with Susan Collins and say, Susan, would you like some funds to build things in Maine? Well, we would like a new port in Maine. We would like something for the fishing industry. We would like something for minerals in our state. We would like something for timber in our state. And they'll get a list of what she wants. And if they put it in the bill, it may be difficult for her to say, I'm against it because there are tax increases. Now, the Biden administration claims, and I think there's a little credibility to this, that any sort of infrastructure spending would produce just millions of new jobs. And over time, it would pay for itself. But there certainly will be some conservatives who will say, no, I just don't want any increase in federal expenditures because the federal government is evil. And therefore, let's just keep them out of our counties, out of our state, out of our communities to the extent we can. So I'm going to vote against this. But on the other hand, a congressperson or senator might have difficult time explaining to his or her constituents why they voted against the bill when there were a lot of goodies that would have come to their community.
One quick question before we go on. So if they can pass this in October with 50 votes as budget reconciliation, isn't there a pressure on Republican senators, for example, to say, gee, if I cut a deal and vote for it now, I can get the goodies for my state. If I wait till October, they may not give the goodies for my state. Does that give them leverage to push this through faster?
You would think. I think that I'm sorry, Jonathan. I think that part of the problem is that the Republican Party has been staunchly against any raising of any federal taxes. Plus, this plan that Biden has put forth is a very big government plan. I mean, he is this infrastructure, proposal that he's touting at this point is almost $3 trillion, and it affects just about every aspect of everyday life. It is just not the kind of thing that the GOP is likely to be able to support with their current constituency. So I think that it's going to be very difficult to get anyone other than the most moderate of Republicans, all of whom are signaling that they're not really going to support it. So the best chance for the Democrats would be to try to pull over some of their more moderate members, which would be, Joe Manchin and Kyrsten Sinema.
The bottom line, folks, we don't know what will happen or when. And that's why, as I said in the beginning, the take-home message, one of the key take-home messages, which you knew before you watched this program, was you got to tell clients to move fast because, as Bob has it in big red letters on the bottom of slide number 8, use it or lose it. And it's not just about the exemption. And I've seen too many articles touting the exemption planning, and I'm not disagreeing. It's critical to use the exemption to the extent clients can before it's gone. But that being said, there's a lot of other really vital steps to take. Bob, back to you, and we'll go on to the next slide.
Thank you, Marty. So we're in this use it or lose it situation. Remember, when you make a gift, the first thing you do is you use your old exemption followed by your new exemption. So 2021 gifts will use the old exemption first and then the new exemption. Literally, to be effective, you have to gift away the entire 11.7. Now, I have a lady in the county south of here whose husband died. She received his dessous. She literally has to make a $22 million gift, maybe a little bit north of that, to use up the dessous and her exemptions. So we have to think about that very carefully. Now, I'm not sure.
Bob, let me just reiterate what you said, which is so important. Let's say you've got someone who said, well, I believe they will never reduce the exemption below $5 million. So I'm going to give away $6.8 million. I'll use the difference, which 6.7 million. I'll use of the 11.7, I'll use 6.7. I'll be left with 5 million. So when I die, I'll have a $5 million exemption. And let's assume that she's right. But the way it works, when she dies with that $5 million exemption, the gift she made in 2021 will be applied against that $5 million exemption, so she will have none. As Bob said, if someone wants to use his or her exemption, and you're going to have to make a gift of $11.7 million. And that, of course, for many people like me, unlike Joy and Bob and Marty, that's an awful lot of my wealth to give away. And I might feel very financially vulnerable at that time. And Marty maybe will have some ideas on how people can maybe not have to worry so much about that.
We'll cover it briefly, but there's a lot of material. The point that Bob and Jonathan just made, clients don't understand the mechanics. They get very confused. We really need to educate them. Bob?
Well, let's go up one more slide, please. So, big picture, we had the 99.8% Act. Now we're at the 99.5. Many of the things we're going to talk about today, we will compare to President Obama's budget. These are not new ideas coming from those that are the most progressive in the Democratic Party. These are ideas that originated in the Obama budget, and Senator Sanders is largely borrowing those ideas and fine-tuning them. Let's look at the next slide.
That's very important what Bob just said, because some people try to dismiss Sanders' proposal as he's so liberal or progressive and no one else is going to go for it. What Bob said is really on point. Most of the proposals that Sanders has made were straight out of President Obama's green books. These are not off the chart left-leaning proposals. These are things that many Democrats feel comfortable with, or they wouldn't have been proposed by President Obama year after year. So we really need to take this stuff very seriously, because they do have the ability, as Jonathan and Joy explained earlier, to push this through. And maybe it'll be as attached to a reconstruction bill, maybe not, but then certainly by budget reconciliation in October. So we really need to take it seriously and plan for it. One of the other things, and I may be wrong, but just an observation, in the 99.8% Act that Senator Sanders had proposed, I think in early 2019, the maximum rate went up to 77%. The highest rate in the current version of his proposal is 65%. Is it possible that he's really being shrewd and careful and knocked it from 77, which, maybe upon talking to other Democrats and maybe even some Republicans said there's no way we're doing that? Maybe he knocked it down to 65% to make the bill more palatable. Maybe this was all calculated to sort of lay a foundation stone for what the Democrat proposals may be, and he started it a notch down so it would be less offensive to many others that whose votes will be needed. Bob?
Now, all these proposals are similar. $1 million gift tax exemption and a $3.5 million estate tax exemption. Of course, the $3.5 million is going to be reduced by prior gifts, just like we have today. Portability would be retained. Now, at this juncture in time, every lawyer and CPA that is touching a federal estate tax return or touching a taxable estate, if I die today and I'm worth $5 million, you're going to have to say to my wife, you need to file an estate tax return, even though there's no legal requirement to do that, because we want Bob's exemption to port over to you. 24 months ago, you might have ignored this, thinking husband has 11.7, wife has 11.7, this couple's at $7 million, she's 90 years old, no worries in the world. But today, we need to assume that the surviving spouse is only going to have a $3.5 million exemption. So very important, we should be filing many more portability returns. Let's look at the next slide.
And Bob, am I correct that if you port it over, let's say at the $11.7 million amount that the first spouse to die had when he died a few months ago or dies right now, and the surviving spouse inherits that $11.7 million to sue from him, she gets to keep it even though the exemption is otherwise going to go down?
Exactly correct. So if a gentleman died on December 31st, his 11.7 is going to go to his wife regardless of what happens to her exemption, Jonathan.
And that's why it's so vital to do what Bob said. You got to file estate tax returns, whereas even if a year or two ago you may have said, you know what, even combined, they don't need it. Why on earth take the chance? And by the way, and it's out of context, but I just want to make a point. Where you have prior estates where you filed and you have a deceased and deceased spouse unused exemption amount, the deceased that ports to the surviving spouse. What happens in a lot of cases is, let's say spouse one dies, a Q-tip is funded, you port the exemption to the surviving spouse. You may even want to go back now, and we're doing this with clients, and re-examine those Q-tip trusts and see if there's a way you can extract assets out of the Q-tip and have the spouse use the deceased now, not only to use the deceased, but don't forget the GST exemptions coming down. GST doesn't get ported. We don't know what's going to happen. So we want to reevaluate all those prior probates that were worked on to see what could be done now. Getting assets out of a Q-tip that are going to be included in the surviving spouse's estate, even making a sale where you lock in discounts, because discounts, as you're going to learn, may be on the chopping block, are on the chopping block. And that's been on the chopping block for a long time. That may go through. So there's a significant incentive to try to use the deceased now and get assets into a better solution structure before the changes. Bob?
So President Obama wanted to go to a 45% rate. Let's look at the next slide. And these are the proposals that Marty mentioned before. We're focused on the 99.5% Act. Today we're at 40%. Even at 3.6 million, you're going to be at a 45% rate, then 50, then 55, and finally 65. Now, forget the 65% rate. That's pretty rare at over $1 billion. But think about if you're helping somebody that's worth between 10 and $50 million. First spouse dies. Do you want to at least fill up their estate to the point, if they died last year, you're still within the 9 months, you can still fail to make a Q-tip. Do you want to run their estate at least up to 45%? Maybe. Or maybe you're going to decide to make a tax-exclusive gift. Maybe what you'll do is say, wait a minute, the gift tax is only 40%. I'll let the property pass to the surviving spouse and have he or she make a gift. The way the tax-exclusive nature of the gift tax works, that 40% becomes a mere 28.57%. Now, that is about half of the rate you'd experience once you got over 50 million. What I'm saying is, for anybody that just died or anybody that's dying, we're going to have to go back to doing the math of when to incur an estate tax at the first death, and when to incur a gift tax even before someone dies. Now let's look at the next slide.
Just in case somebody doesn't follow it, explain tax exclusive and why a gift tax can be a bigger advantage than an estate tax. It's obvious
Sure.
for a lot of people, but for some it may not be.
Right. Let's just say I have a very large estate and I gift away $10 million. When Joy does my 706, she's going to ask me to write a check for $4 million. My 709, my gift tax return. She's going to say, Bob, we owe the government $4 million. I'll write a check for $4 million. But how much did I remove from my estate? The 10 I gave away plus the 4 I paid to the government. So that's 14 million. As long as I lived 3 years, my $10 million gift moved $14 million out of my estate. So that's what we mean by tax exclusive. If I merely died with that 14 million, we'd pay tax on the whole 14 million. When I gift away 10 and pay 4 in tax, that 4 million I had to pay in gift tax escapes taxation. It's a pretty interesting thing. And for large estates, you have to wonder if that's not the way to go. Next slide, please.
Sure.
Okay, the exemption in the rate structure is effective for deaths, GST transfers, and gifts made after 12/31/21. That's good news. That means that we're going to have a window of opportunity to do something, but the question becomes, What's going to happen with the rest of these proposals? Look at the rest of the slides. One more, please.
Yeah, just to emphasize where Bob's going, because it's really critical. I've seen too many articles written and people make comments. Gee, we have to the end of this year to plan. You do not have the end of this year to plan. You
No.
kind of do, but not really. And waiting to the end, towards the end of the year, is a terrible, terrible mistake. Jonathan and Joy have made it very clear, and I kind of commented on it, that we don't know when this act could get enacted. It could happen in the next month or so. It may not happen till October. It may not be effective to the end of the year, but we don't know. Many of the provisions in the proposal from Senator Sanders have different effective dates. And Bob's going to explain it, but just to drive the point home, because it's so critical, if you can use your exemption till December 31 this year, but you're going to lose out on a transfer to the grantor trust being outside your estate, and we're going to go through that, you can't afford to wait. So please don't misconstrue some of the other articles and writings and lectures that we've heard that suggest you have until the end of the year. For one provision, you may, but not for a whole lot of really critical stuff. So be very careful. The message I'm sending out to all my clients is you got to plan immediately. And hey, by the way, even if you plan immediately, because all advisors are so inundated, we don't know that we're going to get it done. Appraisers are backlogged, accountants are backlogged, estate planners are backlogged, and even if you got it done tomorrow, they may still have a retroactive effective date. And Jonathan and I have done a number of lectures. They're on the Schenkman Law website and Interactive's website to show you how to deal with that. And I think at the end of this slide deck, we have some information on that. But you don't know when any of this is going to happen. You just got to move fast and hope for the best. Bob?
Now, there's a couple of important provisions in the bill. Special use valuation for farms can now go up to $3 million. It's about $1,180,000 right now. And this is for deaths and gifts after 12/31/2021. Okay, so that's the special use valuation. And let's jump up one more page. Now, conservation easements also have an expansion under the statute from $500,000 to $2 million. And you can actually exclude up to 60% of the value of the property. And one more slide, please. Okay, now here's the tough part. This is what I think people will begin to call the anti-Hesh and Blockmacher rule. We'll have Jonathan explain this in a minute, but let me walk you through this. When I sell property to a grantor trust, most of us want to be very symmetric with our planning. We want to say, if it's out of the estate, no step up. But Jonathan and Professor Hesh came along and said, that's not correct. The way the statute is structured, basically, if it passes on account of your death, it's going to receive a step up in basis. So they espouse that theory. And you might take from this that their theory is correct, because Congress is coming along and saying that you're not going to receive a step up in basis in that instance, okay? So Jonathan, do you want to just walk us through this for a moment? I mean, I find it very interesting that Congress had to checkmate you and Professor Hesh.
You can gloat if you want. It's okay.
What's that, Marty?
You can feel free to gloat. It's okay.
Well, let me tell you what happened. I came up with the concept of the installment sale to the grantor trust. And one of the most famous estate planners in the United States wrote an article in 1997 saying it didn't work. That the problem was, if you had debt against that property when you die, there would be income tax recognition. And I thought he was wrong, and I wrote him a very respectful letter, and he published part of that letter, but he said, I'm not convinced. And then two other lawyers wrote an article basically reiterating what he said, that you would have a terrible time if you made an installment sale to a grantor trust. The grantor died, and grantor trust status, of course, turns off when the grantor dies, and you would have gain recognition because you would have a negative basis asset. The debt would exceed the basis in the property which had been sold. Anyway, Mitch Gans and I, together with one of our colleagues, Hugh Jacobson, and I, wrote an article which appeared in the September 2002 issue of the Journal of Taxation. By the way, those issues are now very valuable. And we pointed out 7 reasons why you could not have gain recognition when grantor trust status was turned off by reason of the grantor's death. By the way, 2 of the authors that had written contrary articles called me and said, "You're right, we were wrong, we apologize." But we also approached the question is, what is the basis of an asset in a grantor trust when the grantor dies? And we explored it in quite some detail. And again, it's an exciting read. We concluded that you'd get a tax-free step-up in basis, even though the assets were not includable in the grantor's estate. And a lot of people thought we were just out of our minds. How can you have a stepped-up basis when the asset is not includable in the gross estate? And we gave our reasoning. And it was very, very sound reasoning. But when I submitted the article to the Journal of Taxation, John Huffaker, who was the editor, called me and he said, "Jonathan, we published your first book, which was on carryover basis, which we may talk about in a little while. And we published 50 articles you've written, but now you've gone too far. Your position that you can get a stepped up basis without having the asset includable in the estate is just so far gone, we will not publish it." In fact, I was involved with the drafting of Section 1014 for the 54 Code. I worked for the Congress and wrote that provision together with others. 30 minutes later, he said, "Jonathan, this will be the most exciting article we've published in 10 years. So that happened. In any event, in 2009, the IRS came out with a general counsel's memorandum and said, "No step up, Jonathan." But then in 2012, they issued a private letter ruling in which they said, "Yes, you will get a step up." People began then to ask the question, "Can I get a step up in basis?" And the service said, "We're not going to rule. We're studying the matter." And it still studies the matter. But the bottom line is that this concedes in this bill that, yes, if you have a grantor trust and status will turn off when the grantor dies, you do get a stepped up basis. That's what that means. And Mitchell's and my position has now been, I think, verified. And I've done it for a lot of clients, and I think you can too. So if you've had a client who died with a grantor trust and grantor trust status was turned off by reason of her death, maybe you can go back and say, "Hey, surviving family members or estate, you got a stepped up basis, even though it was not includable in the estate." Bob, back to you.
Thank you, Jonathan. Next slide, please. So now here are the valuation rules. This is by far the most serious thing. So appraisals commonly consider adjustments for marketability, we know that, minority interest, blockage, and taxes on built-in gain. Okay, so we have all that going on at once. And some of this is going to change under these rules. Look at page 19, please. Now, under the general valuation rules, non-business assets of an entity transferred are valued as if the asset were transferred directly. And non-business asset means any asset not used in the active conduct of a trade or business. Passive assets are not treated as used in the active conduct of a trade or business. Let me help you with this. Okay, within about 2.5 hours of Green Bay, I represent this company. It was created, they started this company right around the Civil War, just before the Civil War. We're on the 6th or 7th generation. And there is a tremendous investment portfolio inside this C Corp. And those would be non-business assets. Now, if the patriarch, the current patriarch, died today, we would undoubtedly be able to take marketability and minority interest discounts on that. But this bill would cause us to pull those out, and then we would value the rest of the entity, and then we would add back in those securities. So this is a very important thing to understand. Now, this is not effective until enactment. So you do these things today, you're going to be fine. Now, if you do something like this today, you're also going to receive minority interest discounts. Here's what they're doing with minority interest discounts. No discount is allowed if the transferee and family members have control or majority ownership after the transfer. So dad gives to daughters the business, their family taken as a whole owns 100%, no minority interest discounts. And we're going to talk about how they define family, but they're going to use the words in IRC section 2032A to define family. So let me take a second here and let's see what Joy and Marty and Jonathan have to say about losing our minority interest discounts.
Well, so basically what they're attempting to do in the act is set up two separate, like a bifurcated valuation. I'm imagining that we're going to see, particularly for your C corporation, your Green Bay company, we're going to see one valuation on one side that's going to have the business assets. It'll have to identify all of those business assets, then evaluate the interest and determine whether it's appropriate to take a lack of marketability, lack of control, any other discounts that might be attributable. And then on the other side, it's going to have to look at what those non-business assets are, identify them, and then determine what the value of those are with no discount based on the percentage interest, sort of a look through. So if I'm giving 10%, if I've died and I own 10% of that company, you're going to have to evaluate all of the assets and then separate the valuation so that on the one side, you've got your valuation discounts, but on the other side, you're just taking a straight 10% of that portfolio. It's really going to create a lot of controversy when these valuations are coming through. But since valuation discounts have been on the chopping block for some time, I think that it's very likely that we're going to see some iteration of this prohibition against discounting.
Well, this is not the first time that this has come up. Under section 6166, the deferral of payment of estate tax with respect to certain closely held business interests, only active business interests count for purposes of determining what you can defer under that particular section. I think that one of the things people will want to do is begin to have records as to why we are holding those assets which are not directly involved. For example, we're intending to expand the space that we're in. You have a car dealer and the car dealer says, I plan to build a new facility where I can house more cars or open up another shop or something like that. And your clients will need your counseling on that because this is, as Joy just indicated, a very big deal for some businesses, especially like Bob's, which has been around for 7 generations, and they've accumulated quite a bit of wealth inside the corporation.
Well, and I think that it really hurts the smaller businesses in a more significant way, because it's the smaller business owners who are less likely to have advisors who are going to be able to help them have the backup and the support to make those types of arguments that will allow them to have extra, quote unquote, extra cash and assets on hand. And it can really, I think that's really going to be the casualty here, will be those smaller businesses who are not as well advised as some of our larger clients.
And don't forget, when you have a $3.5 million exemption instead of 11.7, that smaller is a lot smaller. Couple of comments. We used to, long ago, help clients each year review with their accountants or their CFO their financial picture and address reserves and why they were keeping them, as Jonathan explained, to avoid a personal holding company tax. And we'd often craft minutes for the corporation to sign documenting the business purpose for the holdings. Those are forms and approaches and a sort of type of analysis that we may need to dust off to support the discounts on working capital and why it's retained in the business for a number of clients. Another point, this is not going to affect all types of discounts. So let's say, for example, I have an LLC that owns 20 raw parcels of land in a particular county. Well, we may have a blockage discount, and I'm not sure a blockage discount is prohibited from this. I can't tell. I don't know if Joy, Bob, or Jonathan have a different view, but it would seem to me that a blockage discount may in fact be permissible, even though it's a non-business asset, non-business in the sense that we don't meet the 469 passive loss test for material participation, which often requires 750 hours. So I'm holding the raw land, but I have so much raw land in that LLC in this particular county that it could take us 20 years to liquidate it. That may go to valuation and may still be permissible. I don't know if any of you have any different thoughts on that.
Certainly not carved out in the case of a publicly traded company that someone owns a major percentage of that company. So that's clear. I'm not so sure if we can use it with a closely held business, because that still kind of goes into the marketability.
I don't know. I think those are issues that we're going to have to address. We'll have to see what guidance, what committee reports and so on if something like this is enacted. But it's going to get very complicated. But the biggest take-home message, and I think Bob said this in the beginning of his discussion at discounts, this is a biggie. So if this happens as of the date of enactment, you don't want to be sitting there waiting until December, after Christmas this year to make a gift, because you can use your exemption, even if that's not going to be reduced until the end of January 1 next year. If you have clients with discountable assets that won't be discountable under the new law, there may be an incredible incentive to plan immediately so you get those transfers consummated before the effective date of this legislation. And that's why I said earlier, it's not only for the assets the client has in their own name. You want to go back and look at all the Q-tip trusts that are out there that are going to be included in the surviving spouse's estate. And if those have interest in a family business that or investment assets that could be discounted today but won't be discounted under the new law, if you can find a way to pull them out of the Q-tip if the trust permits it, and if not, you may be able to decant to modify those powers, and that's something to think about and see if it's feasible. And you can pull those assets out and have the surviving spouse transfer those assets into a GST exempt trust, and we haven't even gotten to those restrictions, and do it at a discounted rate. That could be a grand slam, not just a home run, compared to what post-act, not end of year, post-act law will be. And mind you, if you do go to revisit a Q-tip to do that kind of planning, make sure you give some thought to 2519. Remember, Code Section 2519 provides that if surviving spouse gives up any of her income interest in the trust, even a penny, that it's deemed to transfer the entire trust. So just make sure you look at that in what you're doing. Bob, ready to next slide?
Next slide, please. Okay, non-business assets are assets not used in the conduct of a trade or business. So a stock portfolio, let's say you're a Ford dealership and you have 100,000 shares of Ford in the corporation, that's a non-business asset. You're not going to get any valuation discounts at all. Those assets are going to be valued as if directly the transfer had transferred the assets to the transferee. So from grandpa right to son, or from grandpa right to grandchild. So next slide, please. Now, on non-business assets, you are allowed to exclude working capital. So you're basically inventory and AR plus whatever working capital you have. If you remember from the PHC rules and the accumulated earnings tax rules, there are a number of formulas the courts have looked to over time for that. We can probably rely on that as a pretty good indication of how to compute working capital. Now, real property, so an apartment building with material participation is going to be considered a business asset if you meet the material participation test under 469. So let's say that my dad left my brother and I a big apartment complex, and my brother's there every day fixing stuff, asking tenants to pay their rent, helping craftsmen and other workmen find their projects, and I'm just sitting here at the CPA firm. Well, I'm clearly not working in that business. I do not materially participate. So my brother would meet that test, but I would not, okay? This is very important to understand. Right now, we do not have a test like this for discounts. What they basically say is no discounts on that real property. So you could lose both your minority interest and your marketability discounts. That's why Marty alluded to this. We need to move quickly to help people with this. Page 22, please.
Before you go on, this emphasizes what I think has been a trend in estate planning for years, and it's just going to get worse. And what is that? If you grew up from the legal side doing estate planning and may have incredible expertise in interpreting legal provisions and crafting legal documents, a lot of the stuff that we're talking about goes back to income tax provisions. We're talking about passive loss rules under Code Section 469. We're talking about personal holding company rules, PHC rules. We're talking about rules that accountants, and especially accountants years ago before the laws kind of changed, dealt with on a fairly regular basis. So just make sure that if you're really approaching this from the legal side, that you buddy up with the client's accountant or accounting firm and get the right experts to help guide you on some of this planning. It ever more so is going to be a team effort. And when you look at some of the comments or think about some of the comments Bob made about paying a state tax on the first death, like, oh my, who would think of that? Or using up the dessous, or incurring a gift tax today. You know, you're going to have to do the analysis, the present value calculations to see how that all plays out. So you may want the accountant involved, you may want the wealth advisor involved to do some forecasts. This is becoming more of a team game than ever before. And as always, with all tax changes, it just seems to make everything more complicated. I don't know that yet in my career I've seen a change that ever actually simplified anything.
Well, and to dovetail what Marty had just said, I think that having the corporate counsel involved is going to be really important too, because maybe you can, you know, have that backup and support all of the money that you want to keep on hand.
Yeah.
Now, what are non-business assets? If you have anything where you own 10% or more of, there's another rule which is designed to prevent any discount for non-business assets held in a lower tier entity. So no more tier discounts, and the upper tier entity is treated as owning its ratable share of the lower tier entity's assets. So we've all seen this. Yes, go ahead.
Is this like when we went into the fun house as kids and you had the two mirrors and it got smaller and smaller and smaller?
It's like one of those Russian dolls, Marty. I've had estates where you have a two-tiered family entity, and then they own 40% of something one of their friends is in, and before you know it, you're getting 3 levels of discount, and $1 becomes a quarter. And you know, I had this with the IRS, and the IRS agent very nicely and politely said, "Walk me through this. How did we get, you know, from $1 down to a quarter?" And I showed them the 3 levels of discounts, and they were not enthusiastic. So let's look at the next slide. This is how we define family. So we're going to look to 2032A. Ancestors. You start with the individual. You look upstream to their ancestors. You look downstream to their children and grandchildren. You look to their spouse's children, and seemingly you look to their siblings. Okay, so you're going to have to look to their siblings. If you look at the next slide, we can put our mind around that rule.
Yeah, just a point. It doesn't matter if you don't get along with any of these people. The client, if they hate them, it doesn't matter. This is a mechanical rule. You know, we used to argue that discounts on family transactions were justifiable because the family was fractionalized. I mean, most families seem fractionalized and dysfunctional. It doesn't matter.
Okay, now here's the rule. You're going to have to read this on your own and take some time with it. But member of family with respect to any individual. So that's you. So your ancestors, your parents and grandparents, you would count them. The spouse of such individuals, so your spouse, you would count. Now here's a tough one. A lineal descendant of such individuals. Stop right there. That means your children. We all agree on that. Lineal descendant of such individual's spouse. So your spouse's children and grandchildren. Now, and this is the tough part that I find tough, or of a parent of such individual. So that's going to bring us into where we're talking about your siblings, okay? And then we're going to look to the spouse of any lineal descendant described above. And of course, now we have adopted children are going to be in the mix. So this becomes very tricky. We need to make sure we eventually understand what this provision means. And I'm sure there's a lot written right in 2032A in those portfolios. There'll be a lot of guidance on this. Let's look up at the next slide. Here's the most important slide in this whole deck. The new valuation rules are effective to transfers made after the date of enactment, not after 12/31/2021, after the date of enactment. If this is enacted October 31st, that's going to be the end of the music will stop right there, and your clients will be subject to these new valuation rules. And keep in mind, the IRS has been looking at doing away with the valuation rules forever. There was talk of 2705 of the code. There was talk of issuing regulations. I mean, just what President Obama wanted to go after some of this. So this may be the service's opportunity. Let's look up at the next slide, please. Now, here's how we think it works. Before enactment, you had a client with 10 million of, let's say, apartment buildings, 32% discount. They're down to $6.8 million. After enactment, you can scratch the marketability and the minority interest adjustments. A difference of basically 3.2 million of value. Now, what about the estate tax? Even at a 45% rate, what we're talking about is now $1,440,000 of difference. Now, if the rate today is 40% and the rate tomorrow is 45, that puts another 5 cents into that, okay? You're going to have to create Excel spreadsheets to run the numbers on this. Those are not easy. I spent yesterday a good 2-3 hours working on one with an example for a physician client of ours. And you're going to have to be very careful to make sure you're taking everything in the right order. Now let's look at the next page. Now, hopefully this helps. Okay, so imagine a set of clients. You have an automobile dealership. They come to see you. Are they a trade or business? Of course. I mean, cars are being fixed. Cars are being sold. It's a trade or business. Owned by family members. So everything is within that definition of family. No more minority interest discounts. They still can get marketability discounts if they're all materially participating in, if the donor is materially participating. Now, what if they had a $20 million stock and bond portfolio in the C Corp or S Corp? You subtract out those non-business assets and you value the business without those, and then you add that back in. So that's how a dealership would work. What about an apartment building? Is it a trade or business? Sure. Is it owned by family members? Yes. No minority interest discount, but you probably are still going to get marketability because you do have a trade or business. You have to get to that magic word of material participation. And the problem that Marty alluded to, what the IRS and Congress are quickly forcing, they're forcing basically lawyers to very rapidly increase their skill set on income tax. And they're going to force CPAs to very quickly increase some of their skill set on the estate tax side of things. Because there's
hopefully, Bob, it'll get them to collaborate more with us, right? I mean, that I think is really the goal. You know, it could be a goal here, or it could be at least a silver lining, is that attorneys and accountants will work more closely together to get to these points.
We collaborate with all CPAs, Joy, just not you.
But right, that's the ultimate goal. But it's but you are going to have to have a higher skill set on both sides of the equation. Now, what about a triple?
Can I pause
Oh.
you before you go to the triple net lease? Let me raise
Sure,
a
of course.
question. Jonathan, you may want to comment. So let's say you have a client that materially participates in an active business and can qualify for the discount, but they're sitting on the business. What if that client is incapacitated? What if that client can't work? What if the client, because of age, has to slow down? Does that change immediately the characterization from material participation to not? So is that a risk that's ongoing for every client that may want to get a discount? I know there's this issue had arisen and there's some guidance under 6166 where somebody, because of health issues, had to stop working. But do we have any guidance under 469 as to?
Well, we do under section 2032A for real estate used in a farm or another closely held business, where if you're incapacitated, but you have agents or you have family members who basically carry out your functions, you're okay. And I think that that will apply here as well. So
But the test, Jonathan's under 469. I'm not aware of what guidance we have under that. Do you think they would apply similar concepts here?
I think they're going to apply the 2032A concepts, Marty. Just
Bob,
because
Joy,
just because you have someone who's had a stroke or someone who's too old to continue to operate the facility, that's not going to cause it to lose it being an active trade or business. I'm quite confident of that.
Would you think, though, that there would have to be some time between, so that, you were incapacitated, and then within a period of time, that's when the transfer occurred, rather than, because conceivably someone could be incapacitated 10 years ago, and then the family exercises, using some kind of power of attorney that they might have, or, maybe it's an irrevocable trust, and then they try to make transfers. But it's been so long since the individual was materially participating that it just doesn't work anymore.
Well, under 2032A, you have to have had material participation, in some cases 5 years, in some cases 10, but family members and others can go in. So if you have, say, someone at 70, let's say, who just can't physically do the work anymore and is basically retired, and they even have a special rule for widows and widowers. So you've had someone who's run a cattle ranch out there every day working, riding horses. He dies and his wife doesn't have to do the same things, or it's the wife who was active and he comes in. So they want to keep it in the family. The family has to have the material participation. And as Marty was indicating, under 6166, you could even have agents do it. So I've had circumstances like with a building where the owner was just incapable of doing it anymore, but he or she had workers who carried it out. And that attributes that activity back to that person, so it qualifies. This is a very, very big change, and I think they will be relatively generous in allowing you to qualify.
The key point, folks, is this is really complicated, and there's a lot of uncertainty. But the most important point, which Bob stressed greatly, get your transfers made while you know you have discounts. Don't wait for this. And if this does get enacted, there's a whole lot of issues like the one we just belabored for a few minutes on material participation that we're all going to have to grapple with, and they're not going to be simple. And they may turn on which code sections are referenced, because there are differences between some of the different code provisions of how this has been treated. Bob, you want to do triple net lease?
Of course. So now your client has 15, he owns 15 CVSs and Walgreens scattered across the country. Every one of them is triple net. There's no argument that the client materially participates. All owned by family members. We're going to lose the minority interest, and we're going to lose marketability. That's the heart of it. And the entire interest will be treated as a non-business asset. So something worth $10 million today, which would have a net value after discounts of, say, 6, is suddenly going to be worth the entire $10 million. That's why we need to look at this. Now, the problem is the clients are going to say, well, wait a minute. if I hang around, I'm going to get the step up in basis. And you would say, well, maybe not. It looks like the step up in basis is going away. And if they were astute, they might say, wait a minute, if I wait and then gift it away, I'm going to get hit with a gain realization tax under this step bill. And there's an inter vivos. I gift a building to my children during my lifetime. We get hit with income tax on that. We get hit with the income tax gain. So right now, none of this is law. And there's a window. It's just that simple. Now, the Van Hollen bill that on the gain realization side, that has an effective date, this is scary, of 1/1/21. No one believes that that will actually come to fruition, but you want to show your clients a copy of that bill and make sure they understand that, yes, when you make a gift to take advantage of the estate tax rules in the bill that becomes effective next year, you're taking a risk that you could have this gain realization. So just be very mindful of that. Protect yourself at all costs. Can we go up to the next slide, Marty?
Yeah, I'm just writing a note because I got to add that to my next series of emails.
Okay, now, a GRAT. For years, people have used grant and retained annuity trusts to basically shift growth downstream. Very often with clients, we will call these freeze trusts. And the rate this month is 1.2%, very low rate. So all the growth above that point is frozen and pushed downstream. It's a statutory tool under section 2702 of the code. You can't mess this up, okay? It's very relatively easy to get this right. Congress knows that, but now Congress is turning on the GRAT. It's going to go to a minimum 10-year term and no more 99-year GRATs. And if I did a $10 million transfer in a GRAT, my gift would have to be $2.5 million or the greater of 25% of the transfer or $500,000. So Jonathan, Joy, Marty, is the GRAT dead?
So let me
this is definitely, go ahead.
So GRATs after the effective date of this law, I mean, I don't want to say never because maybe we'll find some applications or some unique circumstances, but GRATs are designed to make transfers which are leveraged with negligible exemption. So no one's going to do them. The 10-year term for many clients that are elderly, the mortality risk is significant. So it seems that post-effective date of this change, GRATs are gone. But we need, and this is just, I want to illustrate for almost every topic we're talking about, you need to know, what do I do today before the law changes? Discounts, as Bob and we all discussed, you got to move now because once the effective date of the law is, you've lost all your discounts. What do you do after the change in law? Well, maybe there'll be some ways we can get certain discounts and we're going to have to plan. We talked about that. With GRATs, it's the same thing. After enactment, there may be no use for GRATs at all. I don't want to say never or zero, but it may in fact be never. But until this law is changed, GRATs in the current low interest rate environment remain a phenomenal tool. I'm going to make a generalization, which may not always be true, but I think is generally true. Unless there's an unusual circumstance, if the client hasn't used up all their exemption, use exemption in non-GRAT planning. Make transfers to lock in discounts, lock in GST, and get assets into probably grant or trust, and we're going to talk about that. But as to GRATs, if you've used all your exemption and you still got assets you want to transfer and you want to lock in some discount values, right? Maybe a GRAT is the way to go. Because if you've used all your exemption and you can do a GRAT that uses insignificant dollars, like $1, $100 of exemption, a GRAT could be a phenomenal tool in a low interest rate environment. But you may want to do GRATs very differently than you've ever done them before. And I'll say this fairly quickly. Jonathan and I did an article on this, and if you want more information, email me and I'll send you the article. But you may want to do a tier of GRATs, a ladder of GRATs, because you want to lock in the technique. Traditional GRATs were designed to cascade or roll rolling grats. So if I did a grat for 2 years, short-term rolling grats, when I get my annuity payment out in a year, I regrat it. The end of the 2-year term, and you can add in the 105-day sort of leniency or framework there, and then you get your next payment, you regrat that. You regrat that, you do a new grat, you regrat that after a year. And they would kind of roll or cascade because you would be constantly taking assets out of the grat for the annuity payment and regratting it. That game is over. That structure that had been so common is over. So maybe what you do now is a 4, 6, 8, 10, 12-year ladder of grats. And if you're going out 8, 10, 12 years, mortality risk is greater. It may or may not make sense, but it's certainly worth discussing with the client using life insurance to hedge that mortality risk. But if you can lock in the grat technique, which can be very valuable because the upside appreciation over the current low 75/20 rates can be sliced off outside of the estate, the upside volatility. If you immunize a grat, that's going to change. I don't want to get too deep into that, but there's a lot of interesting planning to do with grats before the law changes, but it's different than what you did before. Once the law changes, it could be like that car insurance commercial, game over.
Joy,
grats, yeah, I did. I just wanted to point out, because this is kind of Marty's point from the beginning, and that this is not just a darling of the progressive movement. This forcing grats to be minimum of 10 years and requiring there to be a gift part of the grat has been in Obama's Green Book. Was in Obama's Green Book just about every year that he was president. So this is more of a moderate Democrat proposal, and that makes me kind of think that it's much more likely to be part of the final bill that gets signed. Plus, let's look at what they're doing. Look at what the bill is doing. The gift exemption, the lifetime gift exemption, is reduced to $1 million, and then on top of that, they stack this prohibition against using zeroed out grats as a way to avoid that $1 million exemption. So, whereas we would say, oh, okay, you don't have any more exemption yet left, let's use a grat. Well, now you can't do that. And as Bob is going to talk about, some of the other provisions further hamper our ability to push out and leverage out wealth without using any exemption. So this is a very thoughtful plan that has been put together, really attacking the tools that we've been using for the past couple of decades in order to push wealth out. And this is really just one of them. So I think that while I have to say that when I saw this slide, I got a little shiver from the tombstone, I don't really think that it's all that off base.
Let's go. Okay. Now, again, effective date of enactment. Okay. So we need to focus on that. The only thing that's really effective 1/1/22 will be the change in the exemptions and the change in the rates. One more slide, please. Grantor trusts. Now here's the scary thing. Assets in grantor trusts are
all the tombstones, Bob.
I just want to emphasize the point.
Too many
grantor trusts, going forward, grantor trusts are done for the most part. We won't be using them because grantor trusts are going to be includable in your estate when you die. So if I funded a grantor trust the day after enactment and it grew from $1 million to 20 million, that 20 million is going to boomerang back into my estate. Now, distributions from grantor trust during the lifetime of the deemed owner will be taxable gifts. And if you turn off the grantor trust, you're also going to have a taxable gift. So I think grantor trusts are going to be done. Now, we have to be very careful with life insurance trusts. We have to think through this. Now, fortunately, if you go to the next slide, there's some grandfathering.
Let Joy talk about insurance trusts for a minute because she's been given some.
Well,
she was upset when we talked about this provision, and I think the important point, folks, Joy, make sure you explain why this is not only for the uber wealthy. This is something that adversely affects every client.
Well, right. Not to get too personal, but I have an insurance trust with a $5 million policy in that. So if I were to have bought that policy, and of course that's because I have 550 kids, so I have to, provide for them if I were to, die before they can start taking care of themselves, which, if you know my son, could be until he's 50 years old. So the issue there is that
this is recorded.
Well, he doesn't listen to anything I say anyway, so it all works out. He's a teenager. He knows everything. But the point is that if someone who were, just starting out, bought a life insurance policy after enactment without even realizing it, just trying to take care of her family, a $5 million policy, it could be a term policy, puts it into a life insurance trust because that's the smartest thing to do. All of a sudden, she's got basis of, I don't know, $150,000, $200,000 in this policy because that's the premiums that were paid before her death. And then at her death, it's a $5 million policy. So now all of a sudden, this person would have a taxable estate where you're just trying to provide for your family. You're not talking about someone who is, in the group of people. Bernie Sanders has in his preamble to this bill, a diatribe about, the Walton family and Jeff Bezos and on and on. That is not who this is going to affect the most.
You're not in that league, Joy?
Not yet. I'm working on it. That's why I'm here today. Yeah, I'm trying to be like Jonathan. But I think that it's really, really key to be worried about these insurance trusts because that's just something that regular Americans are really putting together on a typical basis. And there are people out there who don't have their life insurance policy yet, who haven't set up their life insurance trust yet and won't be grandfathered in. And those are the people who are going to be hurt unless we come up with ways and techniques to modify those insurance trusts so that they don't fall into this category.
So before we go on, let me give you a simple example of something you can tell moderate wealth clients, young couples that you may be doing planning for. You're a young couple in your 30s, you got a term policy, you haven't done any planning, it should be in an ILET, you didn't do it yet. Hey, set up a simple traditional life insurance trust today, right now. Put in whatever you can afford to put in. Have that be a grantor trust. And then in the future, when you need to fund premiums, do not put another penny in post-enactment. Not another penny. You will do split dollar loans or some kind of loan regime structure to fund the premiums, but at least you have your grantor trust grandfathered owning the life insurance. And you want that because if you ever want to transfer a policy, like to sell a policy to a trust, you want it to be a grantor trust. There's implications to the transfer for value rule. There's all sorts of reasons you want your insurance in a grantor trust. And it's kind of hard to have an insurance policy in a trust that's not a grantor trust, because if the income of the earned inside the trust can be used to pay premiums, and it's a little fuzzy on the law, but it generally is viewed as making it a grantor trust. So we're going to have to learn to draft around that post-enactment. But if you structure the trust today before enactment, even for a very modest wealth client, just do a simple ILET and put 10 grand in it, and we'll deal with funding it later. Bob?
Thank you, Marty. Okay, so for this provision, it applies to trusts created after enactment. So as long as you do not create a trust after enactment or make transfers to pre-existing trusts after enactment, or perhaps make sales to pre-existing trusts, you're going to be just fine. Those trusts will be grandfathered. They will not be included in your estate. Now, the concern about sales is, can you ever value a sale fairly? Will you ever get the price right to the penny? And that's an interesting thing. Now, if you file a gift tax return and disclose those, you may be able to take the position that the government should have challenged it on the gift tax return, and you're okay under the adequate disclosure rules. So we have to watch out for that. But now the thing about transfers made to pre-existing trusts after enactment, what does that mean? For example, if the matriarch of the family receives a bill from her accounting firm for $100 related to a little bit of work for 10 different trusts, and she just shrugs her shoulders and says, I'm not going to write out 10 checks for $10. I'll just write out one check out of my personal checkbook. I think she's made a transfer. Then we get into some very difficult portion rules, and who knows how the final legislation will look. But if this comes to fruition, the accounting firms, when they annually do tax returns, are going to be very diligent to make sure that we're not making any transfers to pre-existing trusts. Let's jump up one more code section, or one more slide.
One more code section.
Now, President Obama basically included a similar provision, except he carved out grats, cuperts, and islets. So the bottom line is, how are we going to design islets going forward? And there's going to be another problem with islets because the law is changing the amount of your annual exclusions, which we'll talk about in just a moment. One more slide, Marty. Now, on the GST side, if you have a trust right now that's GST exempt, or you create a new trust that's designed to be GST exempt, you do your gift tax return, you allocate. 50 years later, what's going to happen is your GST exemption is going to evaporate, and you will go back to an inclusion ratio of 1. So 0 is good, 1 is bad. You're going to go back to an inclusion ratio of 1. And to avoid this, you have to draft what's now called a qualified trust, which must terminate not greater than 50 years after the trust is created. Well, the law in this area goes back to the 1600s. I looked this up a little bit, just a history lesson, and that's kind of where the rule against perpetuities was created. We have gone way beyond the rule against perpetuities. Jonathan can tell you that he was instrumental in creating a rule in Alaska. Other people have worked in Wyoming, South Dakota, Delaware, Florida, even Nevada, and they have these dynastic trusts that go on forever. The dynastic trust is basically dead. Now, this statute, if it becomes law, also includes pre-existing trusts. A trust created in 1990 that was properly protected from the generation skipping transfer tax is going to be subject to the 50-year rule. Fortunately, it's 50 years from enactment. Now, you wonder, how do we handle this going forward? We may end up in a situation where at year 49, Jonathan has a great idea called generation jumping. Other ideas might be to sell property out of these trusts at very, very low interest rates into another 50-year trust, kind of like rolling dynasty trusts like we used to use rolling grats. Jonathan, can you walk us through the big picture here and then talk about generation jumping?
Sure. Let me point out that pre-existing trusts don't have to terminate in 50 years. That would probably be unconstitutional, but what it means is that you will have that one inclusion ratio. So if you make a generation skipping transfer after the 50 years, you're going to have to pay generation skipping tax. So say my father created a trust for me in 1990. Well, that means that in 2040, essentially, that trust would now have an inclusion ratio of 1. Now, if the trustee distributed property to me, it's not a problem because I'm not a skip person, so we don't have a generation skipping transfer. But if the trustee gave it to, say, one of my children, who would be a skip person with respect to my father, who created the trust, you now would have a generation skipping transfer and you'd have to pay generation skipping tax. But if you do it before the end of the 50 years, you may be able to get a number of additional decades free. For example, if in the year 49, I transfer it over, say, to great-grandchildren of my father's, if we have any at that time, the property is then, for generation skipping transfer tax purposes, as treated as though it was created not by the great-grandchildren, but by the grandchildren. And you wouldn't have to worry about a generation skipping tax until not just my children, my grandchildren, my great-grandchildren, and my great-grandchildren all die. This is a difficult concept. It took me about a year to work it out. I think very few people use it, but if you drop us a note, we'll tell you all about generation jumping. It's a really terrific idea and one I think people will use here. Keeping in mind that we're talking about events 50 years down the line, and very few people look out 50 years from now. Joy does all the time. Marty does all the time. But Bob and I don't look out 50 years because we don't think we're going to be alive in 50 years, unlike Joy and Marty. But there will be some techniques like generations jumping and some others, which will allow people to continue to have wealth accumulated in the family without having it destroyed by generation skipping transfer tax.
But their generation jumping may become one of the standard practices to deal with this new 50-year rule. But the rule is really harsh, and the dynastic planning that's been the foundation of most estate planning, it ain't going to be the same. This is really dramatic. In addition to generation jumping, if you're going to make a distribution out of a trust in year 49 and change before that 50-year rule hits, and then you lose the ability to make a distribution to the lowest generation, one of the things you're going to want to do is layer on an LLC or FLP, some kind of entity, because if you make distributions to, say, 3 or 4 great-great-grandchildren, you have no asset protection, no divorce protection. So before you make the distribution, you want to make sure those assets are in entity solution, so there's some measure of control, because even though Congress seems to feel that trusts are this evil deed that bad estate planners like us do to help very wealthy people preserve their wealth, there are things that lots of people do in order to protect assets from the 50% divorce rate, lawsuits, malpractice claims, and so on. So we're going to need to address that. Another issue to address, the trust that we wrote in 2020, before we knew that this law could be passed like this, may not permit full distribution of principal. So depending on what you have in the terms of the trust, you may have to decant it or decant it twice, and decant it into a state that gives you more flexibility to be able to permit principal distributions, to even make those distributions out of the trust. So there's a whole raft of issues that we're going to have to tackle to figure out how to deal with these new laws, but it will completely change the face of planning.
Bob, you're muted.
You're muted, Bob.
Let's go up one more slide, please. Now, this is the language basically defining transfers from non-qualifying trusts. Remember, from a GST perspective, you want to have a GST ratio of 0. You want to avoid a GST inclusion ratio of 1. 1 means that the entire generation skipping transfer tax will apply at the highest marginal rate, which arguably could be 55%. So we'll have to see where that rate ends up. Now,
how do you know it's not 65 under the new law?
I don't. I'm
scary.
hopeful.
It's scary.
It is scary. Now, the good news is it's 50 years from the date of enactment. So that if it stays exactly the same, which would be strange, practitioners are going to have 50 years to figure out what to do with this. Now, a qualifying trust means a trust for which the date of termination of such trust is not greater than 50 years after the date the trust was created. So if we settle a trust on 1/1/22, it would have to terminate to be a qualifying trust by December 31st, 2071. Okay, next slide, please.
Jonathan?
Yes,
Would you ever condone drafting a trust that terminates in 50 years and destroy asset protection? Or will you just give the flexibility to make a distribution before that 50-year mark?
Well, Marty, we don't know what it means by saying the trust has to terminate. It may be that that trust terminates, but paying it over, say, to another trust for a grandchild will keep the benefits of asset protection, and yet it will probably qualify. I don't think they're going to force you to take assets out of all trusts. It's just this trust you've created, which now has a 0 inclusion ratio. That trust has to end within 50 years. But I think you can have it paid over to grandkids or great-grandkids or the 8th generation or whatever you want. And that will be a new trust, which will have a 1 inclusion ratio. And so I think you'll be okay.
So the
Think how
trust doesn't terminate, but as it makes distributions to a skip person, there will be a taxable distribution that will then be subject to the GST tax.
That's right. But the language that Bob has up there is correct. It says if you want a qualifying trust, which are new trusts, these aren't previous trusts. If you want a trust where you have a zero inclusion ratio now, because you think you're going to make distributions not just to your kids or for education or for medical, but say to grandkids and great grandkids or people assigned to that generation, you're going to have to provide that that trust terminates within 50 years. But again, I think terminates within 50 years means that trust terminates in 50 years, and you'll pay it over to other trusts which will not have a zero inclusion ratio. But
we
again,
don't know.
generation jumping may be a way to at least take some of the sting out of this new provision.
What about retaining in the trust that will have an inclusion ratio 1, an estimate of how much money I may distribute to non-skip people for their lifestyle expenses, plus funds that could be used for education and medical expenses for skip persons? Would that be a way to salvage some piece of it so we only distribute the excess?
Well, that could happen, Marty. I think once you get it into a trust with a 1 inclusion ratio, which means you pay the full transfer tax on it when it goes to a skip person, they still will have the medical care and the tuition exceptions. I don't think you need to break it off into a separate trust.
No, I was talking about leaving it in the existing trust rather than taking it out.
Well, I think, Marty, it depends on whether you have a pre-existing trust where you don't have to have it terminate within 50 years, or a new trust where it has to terminate, that trust has to terminate. But again, I'm quite confident they will allow you to go into a new trust, which has a 1 inclusion ratio.
One of the other things that I just thought of that's concerning is if you have an institutional trustee, how are they going to get comfortable with these kind of radical changes to the terms of the trust?
Well, they'll just have to learn it, Marty. That's why that's why you and they get the big bucks.
I think what the institutions are going to do is go to court and get court to approve any plan they do, because this is so different than what is contemplated in most trusts. How is a trustee going to be comfortable that they don't have a liability exposure? They're going to have to get courts to bless the plan.
Well, I'm not sure. Marty, I'm not sure that's right. We've had a lot of changes in the law, and normally courts aren't going to give advice. And what you can do is to ask the beneficiaries to agree, and maybe you can bind everybody that way. If you have some sort of virtual representation for younger people, or maybe you will go to court, and or you'll do a piece of it and go to court and get that piece blessed, figuring that that's going to be a blueprint for the future. But this will radically change the administration of trusts.
Radically.
Let's go up to the next page, please. So now on the GST side, remember this is not brand new thinking. President Obama wanted to go to 90 years. And then at that point, the inclusion ratio would have been reset to 1. So again, not totally out of left field. Page 36, please. Now we're going to end with annual exclusions. So right now, just imagine you represent this lovely lady. She's in her early 90s. She had 5 children, and altogether there are 20 grandchildren and 40 great-grandchildren. So she can sit down and write 60, 70 checks every January 1st, times 15,000. Well, let's say it's 70 people times 15,000. So we're coming in at about $1,050,000 every January 1st. What would this bill do? What this bill would do is limit the gift would only be $10,000, not 15, and limited to 20,000 per donor. So normally she could gift away $1,050,000. So I have a client like this, and today, or when we change, when the page turns, she's only going to be able to gift away $20,000. Now, this is devastating for life insurance trusts. It's devastating for 2642C trusts. Jonathan, Joy, what are you thinking here? What do we do?
Well, one of the things, Bob, I think there will be a lot of loans. One of the things you can do for a life insurance trust is to make what's known as a split dollar loan. So you loan money to the trust. The trust doesn't have to repay it until the insured dies, unlike the normal rule that the IRS requires that you have to make it payable within the lifetime of the lender. And the IRS normally says if you haven't paid interest on that loan, we're going to use that as evidence that you never really intended it to be a loan. The regulations, and someone might want to write this down, under Reg 1.7872-15 says that you can go ahead and make a split dollar loan, and you can make that loan payable when the insured dies, and you can allow the interest to accrue. That's right in the regulations. So that's one of the things people will do. And today, because you will use basically the long-term AFR, it's relatively low. But the long-term AFR has gotten a little higher, and some think it'll get higher in the future. And it's been as high since we've had the 75/20 rates of up there in around the 8% category. But again, with a split dollar loan, at least you can allow it to accrue and not have to pay it. The only danger you'll run is where the interest, which is accruing back to the lender grantor. And remember, if it's a grantor trust, you're going to have it back in the estate. So you're not going to want it to be a grantor trust, which means somebody's going to have to pay income tax on the interest that's accrued. That's a real problem. But if you have a situation where the interest rate is high, say 5 or 6%, which it probably will come to in the next decade or so, and if the trust policy is not earning that much, you wind up in a loser situation where you're giving back to the grantor more than the trust is earning, a very bad situation.
So, and I want to clarify something about this provision. It caps at 2 times the annual exclusion only certain transfers. So it does a couple of things. One, it gets rid of the present interest requirement. So, you know, it's actually kind of funny because I've been kind of going through gift tax returns this time of year, and I keep, you know, kind of going through the crummy rules. It seems that if this act were put into law, were enacted, we might actually be able to avoid crummy, you know, those crummy analysis that we've been doing all of these years.
Let me interject. Let me interject.
Sure.
From a tax perspective, you don't have to worry because it could be irrelevant if this is passed. But from a legal perspective, I wonder what that means, because if you have a trust instrument, an irrevocable trust, and I'm thinking of a grandfather trust, and you're the trustee of a trust, and the trust says thou shalt give notice within, you know, a reasonable time of getting any addition to the beneficiaries, you may still want to do it to comply with the terms of the trust. So you may not care on the accounting side, but from trust administration perspectives, people may want to still comply with the terms of the trust. Or if the law now obviates that, you know, can you go to court and change the trust? It's not worth it for these amounts. You'd probably just issue the crummy notices.
But the aggregate per donor limit on annual exclusion gifts to twice the annual exclusion amount is only for transfers and trusts, transfers of interest through pass-through entities, transfers of interest subject to a prohibition on sale, and transfers of property that cannot be immediately liquidated. So if I were to write, you know, checks to all of you after the enactment of this bill, I would be able to do that. I think my husband might have something to say about that. But the point is that you could still make, although actually with his help, I could make, you know, double that, right? Because he could still split. I don't see any prohibition against splitting. So the point is that each donor could still make cash gifts outright. So those, you know, that end of the year, you know, grandma's just really excited to see all the grandkids. The pandemic is over, so we can start getting together again. And I'm going to write a check to everybody. That can still happen. It just can't happen in trust.
So what that may mean, And Jonathan went through one of the primary ways that we may have to fund ILETs with split dollar loans, but Joy just really laid the groundwork for another approach. So I can give double the annual exclusion, and I think it is the 10 and 20,000 inflation adjusted, so it'd be 30,000. So I could give 30,000.
Yeah.
I could give $30,000 to an ILET, but the problem with giving 30,000 to an ILET is I jeopardize grantor trust status because now I'm going to have partial inclusion after the law. But what if I could give the money to the kids and the grandkids who are beneficiaries and let them loan it to the ILET? So that may be another approach. I'm still using my annual gifts and letting the kids loan the money to the insurance trust to pay the premiums that will benefit them.
But you're going to have income tax consequences because you're going to have interest on the loan. And
Correct.
That will be kind of a difficult thing from an administrative point of view, sending everybody a 1099 saying, Joey, Nancy, whoever has made a loan, that you've got to report, $280 of interest income. This will make it very complicated indeed.
Complicated and a pain in the neck. But if the kids or grandkids are in a much lower tax bracket, maybe that's beneficial.
Well, except I don't think that the trust is going to get an offsetting deduction, because this is not going to be, it's not going to be investment interest, because you're using it to pay a premium on a policy of insurance. So it's not going to entitle the payor to any deduction.
So it looks like all the insurance consultants and agents are going to have to really, we're all going to have to figure out what to do.
Well, Marty, let me tell you, the insurance industry will be greatly benefited if all these provisions go into effect. In fact, Bob, do we now want to go to the Van Hollen proposal? You're muted, Bob.
So basically where we are now, thank you, Jonathan, where we are right now, we discuss the impacts of this with our clients. We project estate values with valuation changes. In other words, how much extra value do you have if the valuation discounts go away? Now think about, somebody could have bought insurance 36 months ago thinking that they needed to buy insurance to cover $1, where now that's going to be worth $1.50. So we have to be careful that we have enough insurance in place. We also are going to have insurance in place to cover the Van Hollen bill, which would cause gain realization at death. So it's possible, and there'll be some interplay between these two, but it's possible to, on the same dollar, to have a state tax and to have a gain recognition tax at death. Accelerate funding of grants and grantor trust before the law changes. Accelerate IDGIT sales before the law changes.
Bob?
Yes, Marty.
I agree with your comment. Insurance becomes ever more important given these significant changes. But doesn't that also mean, and I think I may have every insurance consultant on this call hug me afterwards, but you'll have to show me your passport that you're vaccinated. But wouldn't that mean that we want to get these ILETs set up and funded with the insurance and funded with gifts to pay the premiums for the next 10 years, 20 years immediately? Because if we don't get it done before enactment, we lose out on all those benefits. So, boy, if I worked, maybe I should stop practicing law and get an insurance license. Jonathan, what do you think?
Well, Marty, maybe you should. There will be a lot of other things. For example, with this capital gains tax at death, and I've been meaning to look it up, maybe the thing to do is to make all your investments through a life insurance policy. Because when the insurer dies, section 101A1 says everything that comes out is not includable in gross income. And if that stands, Joy, you and I will both get our life insurance licenses. That's
what about me?
Sure. In fact, when I
you're not young enough. I think he was going with the young people, right, on the call, Jonathan?
Thank you.
Right. When I wrote my book on carryover basis, I had a chapter entitled New Life for Life Insurance, pointing out that it was the way to go because you avoided the carryover basis, because of 101A1. And here you will avoid the Van Hollen capital gains tax at death unless they change the law. And Bob, I don't see anything in the Van Hollen proposal, his proposed bill, which would change that result. So 101A1 will become ever more popular.
Yeah, and I think that we need to just emphasize something that Marty had said, and he said it kind of quickly, and that is, I think we need to be looking to make gifts to insurance trusts of assets that will generate sufficient income to pay the premiums. And that hopefully will avoid, and that should be done now before enactment, so that that can then be used to pay the premiums in those insurance policies in order to avoid some of these deleterious effects. Sorry, Bob.
One of the things is to have a paid up policy. You can go to the insurance company and you can say, I want a policy that will pay at least $5 million, $8 million, whatever it is. And you can pay for that right now, just one single premium and you're done. And with the large exemption for those who have life insurance, maybe that's something to do. However, life insurance on a long term is not always a very wise bet. I mean, Joy, you have it because you want your family to be protected. I actually, when I got to be 72 years old, decided to drop my life insurance because, you know, at that point, it was just a question of investment. My pension from my law firm continues from my wife. There'll be no estate tax because it's all going to pass under the marital deduction. So I decided I would drop it. By the way, I ran the numbers. If I live from 8 years, which is 3 more years from me, that will have been a wise move. If I die within the next 3 years, well, I should have kept the life insurance.
Now, just going a little further, Marty, let's jump up one more slide. Okay, so all this happened very quickly, and we do have a little bit on this Van Hollen proposal. So you have 2 people involved in this. In the House, Mr. Purcell from New Jersey. In the Senate, Mr. Christopher Van Hollen from Maryland introduced a bill called the Sensible Taxation and Equity Promotion STEP Act. Now, what this does, at the heart of it, realization of gains upon a gift. I gift to you Bank of America stock I paid $1 for that's worth $39 today. I'm going to have to pick up $38 of taxable gain. Now, if I died and left you that stock, same thing. We're going to pick up a $38 gain. It's not clear whether that would end up on a 1040 or on a 1041. But remember, if it ends up on a 1040, you're going to get an estate tax deduction for the income tax due. And the other way around, if it ends up on a 1041, you'll get an income tax deduction for the estate tax paid. Those are not panaceas. They are not going to make this even. And if you're in a 50% rate, 50, on the estate tax side, and then you have to add in some income tax, you can see it's very easy for you to get over 20% plus 50%, 70, 75%. Now it gets worse than that. There's going to be a bill introduced certainly within the next 2 or 3 months to tax capital gains at 39.6 when your income exceeds $1 million. So just take 50% plus 39.6, mitigate that for the interrelated equation. You're still coming up to well over 70%. That is going to make it impossible for many families that are illiquid, ranchers, manufacturers, farmers, etc., to transfer their business to their children, plain and simple. And I represent this really big farm. We don't do their income tax work, but we just do their estate planning. And at the end of the day, I don't know how we're going to move that down to the children and grandchildren. We have to get ahead of it in the next 60 days.
What kind of legs do you think is on something like this? How plausible do you think it is that something like this could get enacted?
Actually, Senator Warren's office made comments the other day that President Biden was behind taxing the income tax rate at 39.6, having a taxation at death of the gains inherent when you die. So, I mean, Marty, I don't want to handicap things, but I think we have to make sure we tell our clients this is out there and let them decide how to apply a certain amount of game theory in the meantime of what to do. So again, very similar proposals. You can tell that the drafting was somewhat coordinated. The Senate proposal is a little bit broader in that it covers gifts, deaths, and transfer. And then the House language just covers gift or death. And a couple other notes, there'll be exceptions for tangible property, exceptions for property to your spouse, exceptions for gifts to charity. It looks like, and I'll be curious to read the committee reports, but it looks like right now we would be able to gift to charitable trusts. Okay, so we'd be able to gift to charitable trusts. That might become the centerpiece or the cornerstone of a lot of estate plans, if indeed that's true. So we've covered a lot of ground today, Marty. I'm wondering if you want to take it from here.
Well, why don't we each just say some concluding remarks, and then I'll say the final remarks and thank everybody. Joy, why don't you go first?
Well, first of all, I'd just like to thank everyone for inviting me to be part of this panel. It's been a great conversation, and I've really enjoyed hearing from each one of you about this new act. I think that it is a broad proposal. I think I've called it quite an aggressive first argument in the debate. I think that we're going to see some moderation as it runs its way through Congress, but there are a lot of provisions here that have been widely popular among the Democratic caucus for some time. So we can see things like, for certain valuation discounts, I think, are going on the wayside. How that's going to shake out at the end, I guess, remains to be seen. But anyone who who is thinking about planning and who has the opportunity to take valuation discounts should really be doing that right now. This is a great time for us to be collaborating and working together and making sure that our clients are informed about these upcoming changes on the horizon, because while I think it's anyone's guess as to what will absolutely happen, we can be sure that something is going to change, and it's going to really significantly impact not only our higher net worth clients, but some of the more moderate and modestly wealthy clients as well. And that's really, I think, an unintended consequence of this proposal that we really need to be mindful of to make sure that we can address it in our planning documents going forward.
Bob, you want to make some final comments, Bob?
Sure. Let me just focus on one thing, kind of unique. Maybe not many clients are going to fit into this, but if somebody died last year or they're dying and you're still within 15 months where you have the option of not making a Q-tip, consider whether you should pay tax at the first death. Also consider whether you should make taxable gifts. Now, when you look at the first death, there is a very strange provision in the law called Section 2013. You'll remember that's your PPT credit, previously tax transfers credit. It used to be the law is the same, but we did this all the time in the 1990s and early 2000s. If husband died and his property went into a Q-tip for his wife, but you didn't make a Q-tip election, and she had a life estate plus maybe a 5x5 power, later when she died, as strange as this sounds, even though that property wasn't included in her estate, we would get a tax credit which would reduce her taxes. Okay? And today's interest rates are kind of low. It's not as good as it was, but don't just sit there and get clobbered at 50 or 55% later when the second spouse dies. Is there a way to tax some of that at the 40% rate we still have for somebody that died certainly in 2020 and probably in 2021? Jonathan?
Let me say that we don't know what's going to happen, but I think what you want to do is to give your clients an out, which is to set it up so through a disclaimer, for example, it all can come back. Now here we have sample language that I came up with, and I actually used something like this when I did my year-end planning in 2020 because I didn't know whether we were going to have retroactive changes. So if you'll go to the next slide and then even go to the next one, you'll see that I say I authorize Betsy individually as assignee of any interest in the property because I've divided it into two shares, one that's protected by whatever the exemption happens to be, including taking into account retroactive changes that are later made by the Congress, and as the principal beneficiary of the Blottmacher Family Trust to renounce or disclaim property, so that the renounced or disclaimed property will revest in me. And I think this is a great idea. You can tell your clients, look, we don't know what's going to happen. You say you wouldn't really be doing anything, or you don't want to have the risk of having an income tax event or something like that. So go ahead and do the transfer, but we'll set it up so your wife or your eldest child, the principal beneficiary of the trust, can disclaim it within 9 months, which is going to take you to next year. Remember, we only have 8 months left now, which means you don't have to make the disclaimer until 2022, and we'll probably know what things look like. The other thing, and I forget, I think, Joy, you may have made this point, you may be worried, well, gee, if I make a transfer of an appreciated asset, am I going to have gain recognition if the Von Holland rule that it's retroactive to the beginning of this year applies? Don't make your transfer with appreciated asset. In fact, what I would suggest you consider doing is make a transfer of an unappreciated asset to a grantor trust. Oh, well, that grantor trust is going to be back in my estate. But keep in mind, as long as it's a grantor trust, you'll be able to substitute the appreciated assets back in without any gain recognition at that time. So, and it, you know, that's what you have to think about doing.
But Jonathan, if the grantor trust is an existing trust and you get that gift made before the date of enactment, can't you swap later? So you'd avoid the I keep thinking of Van Halen, forgive me, Van Halen effect, but you still are grandfathered in terms of the grantor trust not being included in your estate.
That is true, Marty, and I just don't know why anybody who has any significant wealth at all doesn't do a grantor trust now. In fact, if you say, yeah, I'd like to do it, but I really want to get the money back. Well, you have a couple of choices. One is you can do a so-called self-settle or domestic asset protection trust. So you go to Alaska or Wyoming or South Dakota, and you do one where you're a beneficiary. Also, Mitch Gann, Abby O'Connor, and I came up with what we think is even a better mousetrap than the Domestic Asset Protection Trust. And I can say this because I created the concept of Domestic Asset Protection Trust. But you can use what's something I call a SPAT, a Special Power of Appointment Trust. And if you want to read about that, go to the February issue 2019, almost 2 years ago now, in Estate Planning magazine, and you can read all about it. But I'm going to warn you, do not read that to young children within 2 hours of their bedtime. They will never be able to sleep.
So we all agree we don't know what's going to happen. Joy's suggestion that maybe, you know, this is the first shot over the bow and we'll see what happens and maybe things will be tempered. I wouldn't bet on that. We don't know. I think, you know, anything that can be done for a client now to protect assets and take advantage of what the law is, and all four of us have talked throughout this 2-hour program about that, I think clients should do. I think anyone with any meaningful wealth and anyone who has any need to plan, because as Joy pointed out, very importantly, a young family with a life insurance need is harmed by this law. It's not just about wealth concentration. It's about basic asset protection, basic protecting your family. I think we need to reach out and educate people that you can't count on some of these provisions being tempered. You can't count on a life insurance exception for the grantor trust rules or anything else. I think we all need to plan as much as we can, as fast as we can, and hope for the best. And we've already started exploring, as we've talked to you about, with ideas to deal with the GST 50-year rule. The ideas that we have, I think, like the generation jumping, using assets to pay for education and medical or non-skip people for lifestyle expenses, putting assets in an LLC or FLP for asset protection if they have to be distributed out of trust or into further trust if that's possible, as Jonathan suggested. We're going to all have lots of time to refine what to do after the law when we know it. But I think that the pressing issue is to help guide clients to plan now. And I can tell you that we, like probably everyone else in the entire industry, have been ridiculously, crazily busy, but a very large majority of my clients have done nothing. And I think that's probably true for most practices. And I don't know why. We've been so busy with the clients and the new clients that have come forward, that I hope that the clients that haven't come forward, and I'm sure this is true for lots of practices, come forward fast enough to do something. But I think we all need to reach out. I am going to send an article that all of us are working on for Lineberg, and if you don't subscribe to Lineberg Information Systems, you need to, because when laws are changing this fast, that's the place to get the fastest information you can. So if you don't already subscribe to Lissy, you should. And we're going to have an article in Lineberg, hopefully within a week or so, on all this planning. I'm going to send the article to everybody on my mailing list. I want every client to be informed. I think all of us, all of you, should get something out to your mailing list just to let people know, because people don't understand it. And I think some of the people that are seeing some of the articles written have in their mind, and I think we all talked about it, Joy and Bob in particular, that golly, you don't have to use your exemption until the end of the year, but we've made it very clear that's a dangerously wrong assumption. So I hope that the program was helpful. I want to thank our sponsors, Interactive Legal, Peak Trust Company, our charity for the day, if you will, the National Multiple Sclerosis Society. I want to thank Joy Matak, Bob Keebler, and Jonathan Blattmacher for all their valuable insights. And it was an honor and pleasure to speak with all of you. And I wish you all good luck. Take care.